Ladies and gentlemen, traders all over the planet, we are back with another monthly show with TradeStation and David Russell, their global head of market strategy. If you've been following the show for the last year that we have been producing this content, you are well versed on what's going on in markets. This monthly check in is essentially our rundown on all the important movements that are going on. And David, of course, runs the TradeStation account on TradingView. So, in my opinion, there is simply no better way to get instant access to an expert in markets who is publishing great content from the TradeStation account and running this show. Ask him a question, leave a comment, anything of the sort. And we've got a great show for you as well today. And by the way, this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equity index options, futures, and futures options markets. And many of you are already utilizing the connected brokerage capability on TradingView alongside TradeStation. And so it is just the perfect match to run through the markets with David and the TradeStation team. But before we go any deeper, David, please take it away because we have some disclaimers to go through.
Yep, great to be back with you, Steph. So basically, I'm just showing the standardized returns of some ETFs that we may talk about. Some of these, if you want to take a quick look at them. And this is a TradeStation platform. We're not going to be using it aside from this quick little view. Okay, so Steph, I wanted to just kind of start by looking at where we are, overall in the S&P 500. Because what's interesting to me, I had this markup here I'm going to remove. But the main thing is I think we know that we had a dramatic pullback here. Now, one thing that's interesting, I was actually doing the TradeStation, doing some custom studies with TradeStation, and it turned out that basically we had the fastest drop in volatility in 10 days after that. So it's just interesting. My overall perspective, put it simply, is that in many ways, the event that we saw earlier this month was just a crazy black swan event when all the stars lined up. It's like lightning striking, where basically you had normal seasonality of the summer. You had a news vacuum. Overall, there wasn't much else happening at the moment that happened after the payrolls. And then the other thing was that we basically had this strange thing happening in the yen. So these things together created essentially this violent drop. But what's interesting is the speed that we come back in many ways, undoes a lot of what it really meant. And it was just in many ways just a crazy piece of volatility. So what grabs me here is this was really the big day, this bearish outside day on August 1st. And the fact that we are now holding above it is, to me, especially interesting. So I want to just kind of mention that, kind of holding this level. I think this is an area that we might want to be watching here. Now, we talked a lot ever since the market started rallying back here in November, how it had this tendency of forming these kind of tight, like zones again and again. And, no big pullback, just tightness and consolidation and then continuation. So the question now is, do we do something similar to that in here? Where basically we're above, the high. There's a potential resistance. We're positive on the month, and we're right near the all-time high. And do we then just kind of squeeze with the potential for continuation to the upside? So that really is what I'm watching for here. And I think when we look at the overall situation of the Fed rate cut next month, pretty much well telegraphed at this point in time, the continued weakness in energy and what that means for inflation going forward, the numbers we've seen that show that the job market is not amazingly wonderful. All those things together put us in a spot here where looking for more downside in interest rates is, not a crazy idea. So that's the S&P with this level. I think is very important to even just see. I mean, we just barely touched that, and we're kind of holding it today. Now, the next thing is the 10-year Treasury yield yesterday closed at its lowest level in over a year. The actual closing value of the TNX was the lowest since July. Now, we for a long time were saying the TNX, we've marked this chart up a lot and discussed it a lot. The thing is that, this line here, you can see we have a downtrend, and then a steeper down. You can see it's actually gotten steeper since then. So we've talked about this chart a lot of different ways. These are marked up from our meetings. But the key thing here, I think, is that, this is now essentially kind of giving a sense that the risk of another spike in interest rates at this point in time seems to be pretty much not something people are going to be really worried about. So, I said this was the most important chart, and now I'm changing my tune. The most important chart now is the dollar index, in my view. So the dollar index here, well, there's a lot of ways to look at it. If we look, we did an idea with 2-day candles. 2-day. And what's interesting here is the way that it kind of had this wedge that it broke. Look how it just kind of held and then crumbled through. And I think when you look at this, you can see that this is actually a long period of very little movement in the dollar index. But if you look at this thing historically, there's potentially significant space in the dollar index to the downside here. You can look at the level from last summer, but even then, on the long-term view, a move back toward 90 is not out of the question. Just looking at ranges and things. So I think if we really think about it, the market that a lot of people have grown up in, so to speak, if you've been trading for less than 10 years, you have lived in an environment of relative dollar strength. Currencies have not been very important at all. If you went back to the first decade of this century, we saw significant importance of currencies. And we're going to talk about that later because we want to talk about our catalyst for stock movement. And the thing is that people have to, if we actually start to think, we could be in an environment where currency movement, where cutting and hiking and all these things happening, central banks are no longer at zero. There's more potential for currencies to move here. So from my perspective here, the single most important chart aside from the S&P to watch could now actually be the dollar index. Do we see the dollar break lower and enter a more significant downtrend? Because if we do, that creates a new kind of market that we're going to be operating in. And it also creates an overall favorable environment for risk appetite.
So, David, I have to say the way you started this show, because we've got to go through all these charts about the sort of perfect storm event. I feel like a lot of us are still digesting what exactly just happened. And one stat I was looking at was how quickly the S&P 500 dropped during this. Some people are just calling it sort of like a carry trade panic. And then how quickly it retraced back to its prior highs. I don't remember seeing the market move like that quickly. And I think it was the third highest volatility spike ever. So a lot of us are still trying to process like what just happened in the last 30 days, or maybe even less than that. It's like 22 trading days or something. Would love to hear your sort of analysis on the situation, or what was going through your head when you were watching all this unfold. So maybe people can learn something, and if they see it happen again, they can be a little more composed or prepared or thoughtful.
Well, for me, the big issue was the bearish outside day. This was a massive range, this bearish outside day on August 1st. So that right there to me was the significant signal. I would just say that this is one of those things that it happens. It's random. It is relatively random. It is not as meaningful as people want it to be. And I know that might be difficult for people who see a move of this amount, but there are times when markets just do crazy things. And I think that's how we have to kind of think about this. All the stars lined up for this to happen. And I think that, for people to be trading and over time consistently, these events, when they happen, great or bad. But the thing is that they're not common enough to trade around. The key thing I would say is when you saw the bearish candle, that was something that we were doing a webinar at that time. And we said, this changes the tone of everything. It has downside risk. We identified this level as our target. It went lower. But the thing we noticed was we basically came back, and we noticed at the time that the condition was dramatically oversold. If you go back and look at our webinar from August 1st, we talked about that. We talked about how the market was massively oversold in the context of an uptrend. And we had kind of talked about at the time how that was creating the potential for, some kind of reversion to the upside. So from my perspective here, you have a series of forces in the market. And I would just say that at any moment in time, there's a series of forces pushing the market and pulling the market. And you had the situation with the yen, but then you also had the fact that the calendar, there was nothing positive on the calendar at that moment. And we also had some weakening momentum in the over. I don't have it on this chart, but MACD was falling. We had seen various indications of short-term trend getting more bearish, and we had the seasonality. So I think these things just came together. And if this had happened in, say, a time like early November, it probably would have gone down 4% instead of 8%.
That's so interesting. Can you actually provide more context on that? Because are you speaking because it's summertime, people are traveling, there's
Right.
not as much volume, I suppose.
Yeah, I mean, if you notice in the bid-ask spreads, I was noticing bid-ask spreads were jumping around dramatically, and I don't have a really right now. I don't have a really accurate measure of liquidity, but just looking at it, it seemed to me we were in a period of less liquidity, and that's not a surprise when you think of what was happening with the yen. So, my view of this was simply that this was a freak event, and it's really not anything much more that we should make of it, because you don't want to end up fighting the last war and missing out on the fact that we actually have a seasonal environment, an overall environment that's pretty important. And I would say that the most interesting thing was we had a false breakdown. To me, that, if anything, is a way to really think about this. The bears tried, and it was kind of like the Battle of Stalingrad when they just couldn't go any further, and then it was just a steamroll all the way forward the other way. And I just think that this was something where they went so far and there was no more juice, and that was it. And it just came reversing back. And then the momentum the other way was much more powerful than the counter trend move. So from my perspective, this is something that we shouldn't make too much of this freak event, especially because we can attribute it to seasonality, to technicals, to news, and to intermarket conditions like the yen. The last thing I'll just say is, to me, dollar yen, and to a certain extent, when you really think about it, the Fed is cutting rates and Japan is hiking rates. Well, that is, that's not a big deal. It's a freak event, but ultimately the issue is the Fed is going to be cutting rates, right? So take a step back and realize the Fed is going to be cutting rates. Okay, is that an environment that usually will support significant downside in the market? And the answer is no. I mean, that's not like COVID when the world was ending. We're in an environment here where the Fed is going to be cutting rates. So this was, in many ways, I think, something that can be understood as a bullish pullback. And the other thing is that I would say it might be more useful to watch things like the euro yen, which is more of a true risk appetite. The dollar is a safe haven, and the yen is part of the dollar index. So if the yen weakens, that actually makes the dollar go up. So it's a weird scenario here where if the yen were to gain, that would actually make the dollar. It's because the yen's in the dollar index, it just creates a strange situation. So the basic thing I'm trying to say is euro yen, Aussie yen, those are the ones who are going to give you a more pure measure of risk appetite. And I watch now the euro. I used to watch the euro yen a lot. And so I think people might want to just realize, if we're in a period of dollar weakness, we might see dollar yen move lower, and it just doesn't matter that much. We're in a period of dollar weakness, and that is, overall for risk appetite, historically a positive.
So there's so many things I just have to unpack there, especially your breakdown of the technicals and the seasonality. And my number one question here is, as I was watching this event unfold, it felt like everyone was trying to give it a name or find the exact reason. And what you just said is something I haven't heard yet in months, all the articles, all the social posts, which is, hey, this was just a lot of things aligned at a perfect time. There wasn't. And so I'm just curious, maybe, is that something traders should think about a little more often? That there doesn't always have to be a name ascribed to a drop, like it was because of this one reason. There's sort of there's multiple reasons that lead to a drop like this.
Yeah, I agree with that. I think that's true, and I think we have to be careful of overly attributing causation. The thing is that if the market is sitting at a high and something bearish happens like this, and we're entering a period of just a vacuum of news and a vacuum of positive things that can be happening, you have a lot more potential for something like this to happen when you're sitting at a high than when you're sitting at a low. So I think another thing was simply the fact was the dollar. If you put up the S&P, if you look at it, it was, I don't have it on this chart, but if you look at Keltner channel, it was up above the top of its Keltner channel. RSI had been overbought. So a lot of these different conditions were pointing in a direction of needing a drop. And I think that's important. And I just think that the real thing was that the BOJ was hawkish, at the same time the Fed got dovish. And
Mm.
that was really the thing. And that's just, I mean, that will happen a few times in our lifetime, and it'll create some weird vortex of volatility and of movement. But I think that's really what it was. It was just a freak event.
Very interesting, and I want to add some user just perspective to our chat here because we actually have one viewer who is on vacation, it looks like, or they live on a beautiful island, who is stopping in to say hi. So I think that's awesome just to read off quickly. And also, Trader Raj is wondering if you think that this is sort of the start of a sideways market based off of this recovery and what has just transpired. This quick dip, this retracement back. Is that sort of maybe what we should be thinking about, especially with that support line you have drawn there?
My sense is that um, probably not significant. I think that maybe through September, but the conditions here seem pretty favorable still. I mean, we actually had earnings were better than people expected. We entered earnings season expecting growth of under 9%. We came out close to 11%. So I think right now, when you look at some of the other things, I think the big problem now is the mega cap growth, the concentration in this kind of small set of stocks, and the fact that we're actually seeing the breadth improving now. So, from my perspective, the real story now, and let's go. That's a good way to talk about the real thing, which I think now is the Russell, and the fact that we are seeing a shift that. So, in terms of the S&P, from my perspective, yes, it could be a period of, I don't know if I would say totally sideways, because I think at this point, with the Fed, cutting or expected to cut, and earnings strong, and the normal seasonality in the year end and the election cycle and things like that, I think that we're in a spot here. And also, we've seen a real trough in sentiment. If you look at Goldman Sachs, are saying that hedge funds are really like under exposed to stocks. S&P Global said investor sentiment hit a 1 year low in August. So I think there's a
Wow.
lot of things here that still have the potential to the pendulum to swing back in the bullish direction. So I think, normally when the market rallies this hard in the first half, it ends the year on a strong note historically. So I think saying that it's going to be just a sideways movement for long, I think is not necessarily the case. But I think the real thing is it's that rotation. So the Russell, that was our idea today. And so from my perspective here, if you look at the Russell, I'm going to take this off because that's not what I'm looking at now. But the key thing is that the Russell, we actually did a TradingView idea over here on today on the small caps of the catch-up potential. But to me, the big thing here is the, if you look at it on the weekly, we're still below the all-time high from November of 2021. And also, it's really interesting what the Russell is. We had talked last time, I think, about this trend line that we basically broke a few days later on the CPI report. What's interesting is if you extend that trend line across here, you can say we pretty much bounced at it. You can also see that we held our low from June. The S&P and the NASDAQ went back to levels from May. The Russell went back to the level from June. That's a kind of relative strength. And so I think here we're at a spot where if you look at the RUT divided by NDX, this ratio here, we basically had this giant surge of there's a significant surge on a relative basis, and we're holding a 50% retracement of that. So from my perspective here, when you look at the environment we're in, and you look at some of the other things that are happening, like I don't have it in front of me right now, but there's a TradeStation chart that show we're hitting more 52-week highs on the S&P 500. The advanced decline line hit a new high yesterday. So these things overall, give me a sense that, we could be simply in an environment of a widening, that people have been expecting for a long time. And so I think that might be more where the probability and the odds at this point could be.
So first thing I want to say, David, is as we do this show, I am picking up on some really good tips and things that I like that you do. And I've seen someone else mention your Fibonacci retracements already. I almost want to call it David's Fibonacci retracements because you keep it crisp and clean. You got that 0.5 line through the middle. And that is so interesting to see this ratio bouncing off that because you've shown that several times in our show, and it's been rather important of a level. It sort of makes sense. I can see a lot of people doing this calculation and looking for that. So that caught my eyes right away when you showed that. I just want to say, I actually thought that small caps after that latest crash that we just saw, I really thought it was over. It's going to be another 1, 2, 3 years of sort of bearishness. I'm hoping this holds. I'm not sure sort of what you're thinking about the recent. Okay, perfect. Let's talk about this chart.
I mean, from my perspective here, the fact that it held this higher low, the fact that it kind of has broken out here, I mean, to me, this is not showing anything to be overly concerned about. And when you're looking at, away from the technicals, the fundamental side, there's arguments people have been making, various strategists who've been talking about this. And I also think we're in a situation where individual stocks are starting to outperform. We're seeing more turnarounds, more M&A. We're seeing the situation with the regional banks improving, of lower interest rates and what that means for them. So I think right now we're in a spot where I think the argument is increasingly there in favor of small caps. And this chart is giving us reason, and also that retracement chart is giving us reason to, maybe lean into that a little bit.
And how are you now, just trying to connect the dots here from that interest rate chart that you were showing us earlier too? I was watching Tom Lee, an interview with Tom Lee, and he was saying that an interest rate cut is really another very positive event for small caps, or just the repricing of some equities. And you had that interest rate chart open earlier. And so I just want to try to tie these movements together. Walk us through this interest rate chart again, because now I'm especially interested. And I love that you have the Jerome Powell dates on there too, and that June 2008 high.
Yeah, I'm trying to actually, I mean, it was somewhere in here where we had around July 13th, it was right around here. We had that really good CPI, the negative CPI report that triggered the move. I would just say that the key thing is it's not going to be a 1-for-1 between the 10-year and the Russell, but it is an environment where if rates move lower, regional banks are a big chunk of the small cap index, and they are then in a situation where the assets on their balance sheet become more valuable. And on top of that, you get more people refinancing and doing mortgages, and a lot of these guys are big originators of mortgages. So overall, more banking activity is going to be favorable for them, and also a better impact on their balance sheet. So I think that's really the thing. And then the other thing is things like more M&A, and then also I think more M&A, that's like going to be the other potential. We've been in a relative M&A drought in those two environments. But, if you don't mind, I want to mention, because I have this principle, this concept I use, these 7 catalysts of stock movement, that I think can kind of highlight some of this. There's an article we did, and I think you could share the link, but I basically break down, and this is essentially something for traders. There's an article I did back in June, but I've used these principles for a long time. And this is not surgery. This is triage, so to speak. We're not looking to do serious fundamental research on anything here. We're looking as traders to understand these sort of categories that can have a big impact on stock movement. And so I want to mention that there's these things like volumes, margins, macro trends, strategic action, investor rotation, business transformation, and credit. And in my opinion, having covered the markets for over 20 years now, a lot of movements can kind of base around these catalysts. And so I think what we have right now is we have a macro thing. A macro is a big mega level thing, usually involving the economy or interest rates. And we're seeing that with interest rates moving lower. That is a macro driver of the market. And we haven't really been in a macro driven market for a long time. We've been in a market that has been driven by volume, which is basically growth. NVIDIA sells chips. They sell X chips one year. The next year they sell 2X chips. Apple sells more phones. Amazon has more people using AWS. Microsoft is selling more Azure. Its volume growth has been the real driver. It's when a true growth market is a market when companies are selling more stuff, they're doing more overall growth. And I'd say that the market has been dominated by volume growth, secular growth, which is what the cloud computing story, the e-commerce story, the AI story is. And that has been the dominant form of growth in the market since around 2015 or 16. And what I'm saying now is, with the potential of interest rates coming down, it creates an entirely new potential. One of them is this idea of there being macro catalysts, and the other one is a potential for investor rotation. So in my view now, we have this potential of, we're at the halfway mark, just past the halfway mark of the year, And in the halfway mark of the year, we saw this big move in the Russell. And there are often, you can look back at moments in time when people shifted from one kind of investing to another kind of investing. And it's possible that this is something that we are now at. We could be looking back at this breakout or this move in the Russell versus the NASDAQ. Like, look here when the AI thing started. You can see this incredibly strong move. This was an investor rotation. You could look at it also as the NASDAQ against the S&P. You would also see here back in March of this was the AI breakout back here in March of 2023. So you can see these there was a period of time when AI started, and you can look back at history and you can see these moments of investor rotation. Well, they often correspond with months or quarters, and having entered kind of a new quarter, a new half, this is a potential time for investor rotation. And when these happen, they can last several quarters. And I think it's important just to realize that that's a potential thing that could be a play. It's not just a pure growth story that NVIDIA is going to be selling a lot more chips or something. Everyone knows that. But the thing is that there's different kinds of narratives that can happen. And so I kind of try to look at things to understand, what kind of narrative is at play now. And so that is, I think, an important thing I wanted to mention, and the fact that we have these different catalysts.
So I want to say on this note, for the viewers who are just picking up on this and joining the chat, David is taking us through, it's 7 reasons, right? Seven catalysts?
7 catalysts, yeah.
7 catalysts for specific stock movement. It sounds like you could essentially invert this to be sort of a bearish case. If you think about like the bad.
Oh, yeah.
Okay, gotcha. So it's really 4 stock catalysts for stock movements, upward or downward. And it's a checklist essentially. So if you're watching this, get out a pen and a piece of paper, or replay it, or go to this article and print it out. And every time you evaluate a company, you can effectively run through this checklist. So yeah, let's keep running through this checklist, because I think this is super interesting and timeless as we head into, the back to school season and potentially a rate cutting cycle.
What I would say is, in recent years, the most classic, just pure growth stock or volume story is NVIDIA. They're simply selling more chips. They don't actually say the number of chips they sell, but everyone knows that the actual units have grown. This is measured in just doing more business. Usually when you sell more widgets, you make more money. Sometimes you can cut prices and things like that. But for the most part, when something, typewriters are no longer a big business, but they used to be, right? So that's something that was at one time growth, and now it isn't. At one point, Cisco was a huge growth thing, and now, that the routers is commoditized thing. When you're in a period of true secular growth, think of the Jim O'Neill, How to Make Money in Stocks, a book like that. He's talking about classic growth stories. But you can have other things, just like, companies that are growing because the economy is strong and there's demand for their products and services. But one thing that can make stocks move is simple growth of the number of things that they're selling. The next thing is profit margin. So a good example of this is actually Meta. One of the reasons why Meta rallied so much was because they started cutting costs way back here. And basically, that had a dramatic improvement if you look at their profit margins. Another real margin story recently was General Electric, had this huge turnaround based on a series of cost cuts and things that resulted in significant profit margin improvement. So a margin story is when a company they're either selling things at higher prices, or they're cutting costs by cutting workers, or by doing something else that results in increased profitability. So margins can be another thing. When you look at stocks moving, you can dig into them. So for me, very often, I'm looking at a stock that's running or going down, and when I read about it, I'm looking for one of these things to explain. And it's often going to be a volume story or a margin story. I would say that those probably account for most of the big movements. The companies are more profitable or less profitable, or they are doing more volume or less volume. Now, the other important thing to realize is that these things go together. It's not just one. Usually when you have increasing volumes, you're also going to have higher margins, because over time, as you sell more, you can spread out your fixed costs over more units, which means your profitability increases. So historically, higher volumes lead to better margins because you get more efficiencies. So now the next thing, like I said, macro trends. That's when something is happening with interest rates. We're going into recession. We're exiting a recession. Interest rates are going higher or lower, things like that. those are kind of macro trends. And the important thing to realize about that is they have nothing to do with the individual company. You can be a financial or an industrial, and if we're going into recession, you're probably going to go down. An energy stock or an economically sensitive stock, even if it's a good company that's been doing well, will go down in that environment. And vice versa. If you come out of a recession, you'll often see the cyclical names will rally first with nothing attached to the company. They rally on the macro thing. So that is a bigger story that transcends the individual companies. The next thing, and a good example of that right now is what's happening with the dollar, potentially. Now, the next thing is something like strategic actions. Strategic actions are when companies do something like buy back stock, they spin off businesses, or they get acquired. Those are the sort of things, or they do things, because of an activist investor, like we saw recently, Starbucks. They got pressure from the activist investor. They bowed to that activist investor, and that drove the stock higher. So the thing is, strategic actions, another good example of it recently was Kellogg. Kellogg broke up into two companies, and one of the two got acquired. So by doing the breakup, that was a strategic action. It made the takeover possible. And then the same sort of thing with General Electric. They did a breakup, and then that stock exploded higher. 3M did a breakup, and it's been outperforming after years of underperformance. So strategic actions. The thing about strategic action is it doesn't change the business model itself. It changes the structure of the corporation in some way. Now, it used to be a big catalyst back before 2010. Companies would do a lot of spin-offs, and they'd borrow money to buy back stock and stuff like that. Now, the next thing is business transformation. Now, that is when a company truly changes its business. So an example of that recently was Netflix has started doing advertising, and that has allowed them to actually be a very quiet. I mean, it's interesting. They're not really one of the mega caps anymore, but they're quietly sneaking to new highs here, and they've really have been kind of having some interesting results in terms of what they've been doing with advertising. They changed their way they reported their results. That all these are hallmarks of business transformation. Apple is changing into more of a service provider. Microsoft a few years ago shifted to a cloud computing. Zoom right now, ZM, is rallying, I think today, or at least this week, because they are looking to grow in this new thing with some kind of contact center. They're doing a new business when they're doing customer service, some kind of business. It's called, if you look at it, a Zoom contact center, it's a new business, right? And that's a business transformation. The last one is McDonald's is now trying to do a turnaround, trying to transform their business. So all this is now these are things that are inherent to the company themselves. So business transformation is another catalyst. The last one is credit. When companies basically have something good or bad happening with their balance sheet. That's what we saw with the regional banks. It's what we saw back in 2008. But it's also what we've seen with a company like Carvana. People thought Carvana was going to go bankrupt, and instead of going bankrupt, it stayed alive. It went from $9 to $160 or something like that, or under $9. I think it was under like $4 at one point. The thing is that when a company has a lot of debt, like what's been happening with WBA, Walgreens Boots Alliance, Walgreens used to have no debt. Then they bought Boots. That business went upside down, and now they're going straight down. That's because they borrowed money to buy an asset that didn't work out, and it crushed them. Now you look at something like Carvana, they were trading like they were going to go bankrupt, and when they didn't, you had a big recovery. So these are credit stories. Now, these are all different kinds of catalysts, and I think it's interesting just to realize that when you look out across the universe of things that are happening, you don't have to be an expert on any individual stock or sector. You can just look at it and recognize, oh, it's this kind of event or it's that kind of event. And it allows you as a trader to quickly have a comfort understanding what's going on. And also it tells you what to look for. You might have a stock that's doing a spinoff, and then they're going to rally based on the spinoff, and people will ignore a bad earnings report because they're waiting on the spinoff. So everything is pegged on that strategic event. You might have a company like, for example, Oracle for a while was reporting bad earnings, but their cloud computing division was doing better and the stock went up. Why? Because people were focused on business transformation. And so you can quickly understand what people are looking for. It's kind of like if you go to the doctor or something and they're afraid you have a certain disease, you're going to be looking for confirmation that you have that disease, or or opposite, saying you don't have it. You're looking, what are we diagnosing here? What are we triaging? Is it pneumonia or is it cancer? It's like, and if you're worried about one disease, that's what you're trying to, and it's important just to recognize what is the actual story happening right now with this stock. And I believe, from having written thousands of articles over time, that all of them, for the most part, can be categorized under these 7 catalysts. And the last thing I'll say is, when you have something like legal risk or something like that, even those are going to be pegged to one of these things. For example, a company gets hit with some kind of legal thing. Well, now maybe that means they have to pay a fine, or maybe it means they need to change a business practice. So that then impacts something like margins, or it impacts growth and volumes. So even those sort of events like political risk or legal risk actually matter because they impact one of these other areas.
So I know, David, that you also like to ensure that you have ample time left before the market close to, make sure that you have a good grasp on what's going on in the markets. By the way, that's a good tip for everyone who's watching. But I do need to just use up a little bit more of your time here on the show, because what you just walked us through is simply fantastic. That was essentially, in my opinion, almost like a business school class that we just got. If you're interested in learning about why companies make specific decisions to increase their share price, like, these are some of the decisions they can try to walk through. I was taking some notes while you were speaking. The Meta example is so interesting because, yeah, their growth isn't like NVIDIA's anymore. It's not spiking through the roof, but you're exactly right. They did then focus on margins and they've become far more profitable. And it's fascinating to see how that corresponds with its recent price action as well. The other one I wanted to comment on too for all the viewers, just because I think it's so interesting. And this stuff is, if you love markets, if you're interested in trends, businesses, what people are focusing on or building, was the business transformation aspect. Netflix getting into ads, Zoom doing a call center, like it sort of all starts to make sense. And it's kind of fun actually as a viewer, if you just really took notes on that and listened, to try to envision, like, what would you do if you were in a company's shoes to try to spark a business transformation that leads to more growth. So I like this educational component a lot. And people should know that they can read about these 7 catalysts, correct, on the blog post that
Yeah.
you were walking us through. And how about sort of a general framework for, essentially, how do you now approach it? Like, you find a company, do you go through the checklist? Is that sort of how you work through this process?
I don't really work through the check. I just read the earnings reports, or I look at when the stock is moving, and then I look at the news around those events, and I basically look for these things. I wanted to end by mentioning that right now, a volume story, and we've talked about this. This is a hospital operator. Hospitals right now are on a boom of volume. It's a volume boom. Hospitals, UHS, also ISRG. These are companies that do surgeries of different kinds, or they provide equipment for surgeries. They're all right now in a boom, a volume boom. And that's just the last thing I wanted to mention. But yeah, I look for the movement. I look at, like, for example, this was a big earnings report. You'll notice that it gapped higher and couldn't hold. I read that earnings report, and I've been watching some of these different names. But yes, I look at when the movement is happening, and I try and find articles that explain the moves, and I always kind of look at them within this context.
Got it. So for people who want to essentially apply this to their process, maybe a good starting point is to rewatch David's masterclass that we just got there, correspond that with the blog post that he's written and shared about that, and then try to take it to a chart, just as we're seeing here, and try to see if you can find that some of these key features align with the company you're interested in. And by the way, one thing David and I mentioned earlier before he gave us this masterclass is, I just want to say it again because it's important. Remember, if you find a company and it's kind of going the opposite direction of this 7 checklist, that might mean it's going to be going the other way, simply because it doesn't have great margin. It's not doing any business transformation. So keep that in mind as well. It's sort of a way to maybe defend yourself from getting involved in a poorly run company. And this hospital example, I did not know that was going on. I had no idea these healthcare stocks were.
And see, the thing is, you don't need to be an expert in hospitals. All you need to do is read the thing, and if you read the earnings report, you're going to very quickly see things that say volumes. They're doing more procedures, more admissions. You just look, you see, and that's it. It's just simple volume of units and amount of stuff being done or sold. And if you see that and the stock is moving, you know it's there. And the last thing I'll just say is that some of the biggest winners are when you get some kind of leverage meltdown. I'm waiting to see if, at a certain point in time, we might see that in the energy names, some of the more leveraged energy stocks, if oil really does break to the downside, where they might go down significantly, and buying kind of longer dated out of the money puts could potentially work. And in some ways, looking for those names that have more debt can really generate that outperformance. So, it absolutely works in both directions. That's why we say movement, not appreciation.
I noticed that when you started the sort of masterclass segment here, was it doesn't say 7 reasons for stock to go to the moon or something. It's movement, so it applies to both directions, which, by the way, is a better educational moment in my opinion for all the investors and traders out there, because nothing's guaranteed in markets. There's no 100% certainty of anything, so it's important to know if these things can work in both directions. Well, David, I know that you like to have some time before the market closes to get prepared, see what the closing levels will be. And with that, we're going to wrap up the show. And I just want to say, for everyone who's watching, please stick around for our show next month. I'm going to get that scheduled on our channel so that you can watch it. And David, I think we should even go into this 7 catalyst segment even a little bit more in our next show. Especially, just we know how much can change in a month. We might get a few more examples. I thought the Zoom and Meta examples were enlightening, because now that I look back at it, those really unfolded before our eyes just in the last, this year, essentially.
Great. Well, Steph, look forward to it. Hope you have a great Labor Day and end of summer.
Thank you, David. Thank you. Same to you. And to all of our viewers, thanks for checking in. Follow the TradeStation account on TradingView. You're going to get great market research from David. He's publishing there. You can press boost, you can comment, share it. And we will be back here next month. Please send us any questions or comments. And thank you for watching.